Episode 2: The Mindset of Great Investors. Thinking Your Way to Wealth. Disclaimer. This content is for educational purposes only and is not financial advice. Always do your own research or consult with a licensed financial advisor before making investment decisions. If investing were just about picking the right stocks, everyone with an internet connection would be rich. But the reality? Success in investing is 80% behavior and only 20% knowledge. You could have the perfect portfolio, but if you panic in a downturn or chase fads at the top, you can destroy years of progress in a single decision. In this episode, we'll break down the mental framework of the greatest investors in history, the habits that keep them consistent, and the steps you can take to think and act like them. 1. Patience is a superpower. Warren Buffett has said, "The stock market is a device for transferring money from the impatient to the patient." In 1960, the average holding period for a stock was 8 years. Today, it's under 6 months. That's not investing, that's trading noise. Why patience matters. The market doesn't move in straight lines. Short-term drops are normal, long-term growth is the reward. Quality companies compound in value over decades, but you only benefit if you hold them long enough. Data point. Fidelity once studied its best-performing investor accounts. The surprising result? The top performers were often inactive accounts where investors had literally forgotten they were invested. Action steps. Before buying, ask, would I be happy holding this for 10 years? Set clear selling rules in advance, not in the heat of the moment. Avoid over-checking your portfolio. Studies show frequent checking increases emotional decision-making. 2. Mastering emotional control. Markets are designed to test your discipline. Headlines will make you want to buy when things are soaring and sell when they're crashing. Data point. DALBAR's quantitative analysis of investor behavior found that over a 20-year period, the average equity fund investor earned 3.6% annually, compared to the S&P 500 7.2%, nearly half the return, due to buying high and selling low. How great investors control emotion. Written investment plans. Know your buy, hold, and sell criteria. Asset allocation discipline. Maintain your planned ratio of stocks, bonds, and cash regardless of market swings. Redefine risk. To pros, risk isn't volatility, it's the chance of permanent capital loss. Actionable steps. Create a simple written plan with your allocation, risk tolerance, and goals. Revisit the plan only during scheduled portfolio reviews, not during market chaos. Learn to sit through volatility. History shows markets recover. 3. Thinking in probabilities, not predictions. Legendary investor Howard Marks says the best investors are probabilistic thinkers. They don't ask, will this stock go up? They ask, what's the probability of a good outcome, and what's the risk if I'm wrong? Example. A company has a 70% chance of gaining 10% in a year and a 30% chance of losing 5%. The expected return is positive, but that doesn't mean you go all in. You size your investment so one loss won't cripple you. Why it works. Removes ego from investing. It's about odds, not being right. Helps you avoid catastrophic overconfidence. Actionable steps. Estimate best case, worst case, and most likely outcomes for every investment. Allocate based on risk, not excitement. Review probabilities quarterly. As data changes, your odds may shift. 4. Inversion. Learning from failure first. Charlie Munger's famous line, "All I want to know is where I'm going to die, so I'll never go there." Applied to investing, this means focusing on avoiding big mistakes before chasing big wins. Data point. Academic studies show that avoiding major drawdowns has a far bigger effect on long-term wealth than hitting occasional big winners. Actionable steps. Make a list of never do investing rules. Ask before buying. How could this fail? Avoid leverage unless you can survive a worst-case scenario. 5. Preparation and process over prediction. Great investors don't spend their careers making bold calls about next month's market move. They build processes that work across decades. Case study. Ray Dalio's all-weather portfolio wasn't built on predicting markets. It was built on asset allocation that survives inflation, deflation, and recessions. Actionable steps. Develop a repeatable method for analyzing investments. Test your strategy against history. How would it have performed in the dot-com crash, 2008 and 2020? Focus on execution, not forecasting. 6. Resilience through adversity. Every great investor has faced crushing losses at some point. What matters is how they respond. Example. In 1998, Warren Buffett's Berkshire Hathaway lost $6 billion in a single year. But Buffett didn't abandon his principles. He doubled down on value, and the portfolio recovered and soared. Actionable steps. Prepare mentally for downturns before they happen. Keep a reserve of cash or safe assets for flexibility. Use downturns as opportunities. Historically, buying in bear markets leads to outsized returns. 7. Continuous learning, the investor's edge. The best investors treat their education as ongoing, not something they completed years ago. Warren Buffett still spends hours each day reading. Peter Lynch would visit hundreds of companies every year to stay informed. Continuous learning doesn't mean chasing the latest news cycle, it means building deep knowledge that compounds over time. Read annual reports, study company financials, and look beyond headlines to see what's really happening inside a business. Follow investor letters from people with proven long-term track records, like Buffett's annual Berkshire letters or Howard Marks memos. Create a learning schedule. Dedicate time each week to reading or analysis. Rotate topics. 1 week on company valuation, another on macroeconomic trends, another on behavioral finance. Over time, this builds a multidimensional view of investing. 8. Learning from other investors' wins and mistakes. History is full of valuable investing lessons if you're willing to look. John Paulson became famous for shorting the U.S. housing market in 2008, but that trade came after years of studying mortgage-backed securities in detail. It wasn't luck, it was preparation meeting opportunity. On the other side, think of the dot-com bubble in 2000. Thousands of investors poured into internet stocks with no profits and sky-high valuations. When the bubble burst, many lost 80 to 90% of their portfolios because they had no risk management plan. The lesson is simple. Study the playbooks of both successes and failures. It's often easier to avoid costly mistakes than to replicate a winning trade. 9. Building your own investment principles. Great investors operate with a personal set of guiding principles, a mental framework they rely on in every decision. Ray Dalio even wrote his down in a book called Principles, so he could consistently apply them. Without clear principles, every market swing becomes a new emotional challenge. With principles, you have a decision filter. When you know your risk tolerance, time horizon, and asset allocation rules, you're less likely to be swayed by fear or greed. Write down your principles. Review them quarterly. Revise them only when you gain new, tested knowledge, not because the market is noisy. 10. The compound effect of mindset. Mindset alone won't make you rich, but it can prevent you from destroying the wealth your investments create. Consider 2 investors. One who gets a 10% annual return but makes panic-driven trades twice a year, and one who earns 8% but stays consistent. Over 30 years, the second investor will almost always end up with more because they let compounding work uninterrupted. Good mindset habits: patience, discipline, probabilistic thinking, process-driven investing, resilience, and continuous learning don't just help in one decision. They compound, just like your capital. 11. Action checklist. Thinking like a great investor. Commit to long holding periods for quality assets. Have a written investment plan before you put in money. Think in probabilities, not certainties. Avoid large losses before chasing large gains. Build a process and follow it, regardless of market noise. Prepare mentally and financially for downturns. Keep learning, studying, and refining your principles. The difference between good investors and great ones isn't just what they buy, it's how they think, react, and prepare. Mindset is the foundation. In the next episode, we'll build on that foundation with asset allocation, how to construct a portfolio that works for you in almost any market environment. Thanks for watching. Don't forget to like, subscribe, and follow Capital Outlook 60 for more investing insights that will help you build lasting wealth.